What if I told you the biggest player in the $7.5 trillion a day Forex market isn't a Wall Street trader, a hedge fund, or a billionaire investor, but a quiet institution that doesn't sell anything and doesn't need a profit? Sounds suspicious, right? That institution is your central bank, and believe it or not, it might just be the one pulling the strings behind the value of your currency. Welcome to Finance Sensibility, where we break down the complex world of money into something even a 15-year-old could understand. Today, we're diving deep into the world of central banks and how they shape the foreign exchange or Forex market, possibly more than anyone else on the planet. What is the Forex market? A quick refresher. Before we zoom in on central banks, let's rewind for a second. The foreign exchange market, or Forex, is where currencies are traded. It's the largest financial market in the world, with over $7.5 trillion changing hands daily. Think of it like the stock market, but instead of trading shares of Apple or Google, people trade dollars for euros, yen for pounds, and so on. And here's the thing, this market never sleeps. It operates 24 hours a day, 5 days a week, across every major financial hub, from New York to Tokyo to London. What do central banks actually do? Central banks like the Federal Reserve in the US or the Bank of Canada are institutions responsible for managing a country's currency, money supply, and interest rates. They are not commercial banks where you open a checking account. Instead, they play a behind-the-scenes role that affects inflation, unemployment, and, yep, you guessed it, currency value. Their main goals include keeping inflation in check, maintaining employment, ensuring financial stability, controlling the money supply. But when it comes to the Forex market, their influence is more direct and often strategic. How central banks influence the Forex market. Let's break down the top ways central banks flex their power in the Forex world. Interest rate decisions, the big one. This is the central bank's favorite weapon. By raising or lowering interest rates, central banks indirectly affect the demand for their country's currency. Higher interest rates equals more foreign investors wanting to buy your currency to earn more return. Currency gets stronger. Lower interest rates equals less incentive to hold your currency. Currency weakens. Example: when the Federal Reserve hiked rates in 2022 to 2023, the US dollar became much stronger globally, making imports cheaper and exports more expensive. Fun fact: traders often call this kind of trading carry trading, where they borrow in a low-interest currency, like the Japanese yen, and invest in a high-interest one. Open market operations and quantitative easing. Here's a big fancy term: quantitative easing, QE. It sounds complicated, but here's a simple version. QE is when a central bank prints new money to buy government bonds and inject liquidity into the economy. This pushes down long-term interest rates and, guess what? Floods the market with currency. More supply of money usually weakens the currency in the Forex market. This happened in the US after the 2008 crisis and again during COVID-19. That's one reason the USD temporarily weakened even as the economy was recovering. Currency intervention. Yes, they literally step in. Sometimes central banks don't just influence the currency, they go in and buy or sell it directly. This is called direct currency intervention, and it's used to either strengthen or weaken their currency based on national interests. For example, the Bank of Japan has frequently intervened in the Forex market to stop the yen from getting too strong, which would hurt Japanese exports. Another fun example? In 2015, the Swiss National Bank removed its currency peg with the euro. The result? The Swiss franc skyrocketed by 30% in minutes, causing massive chaos in Forex trading. Verbal intervention. Yes, words can move markets. Sometimes, central banks don't even have to do anything. Just talking about future moves is enough to shift currency values. This is called forward guidance, or jawboning. Example: when a central bank official hints at future rate hikes, traders immediately price that into the currency markets, often before the policy is even implemented. Markets react more to expectation than reality. That's why you'll see currencies spike or crash right after a central bank makes a statement, even if rates didn't change at all. Setting currency pegs, especially in emerging markets. Some central banks fix or peg their currency to another, usually the US dollar. They do this to stabilize their economies or control inflation. For example, China's yuan is loosely managed against the dollar. Many Middle Eastern countries like Saudi Arabia peg their currency directly to the US dollar. This means the central bank has to constantly intervene in Forex markets to keep the peg. It's like trying to keep a balloon submerged underwater. It takes effort, and it's not easy when global forces are pushing back. Why this matters to you? You might be thinking, okay, this is cool, but how does this affect me? Well, here's how. Traveling abroad? Currency fluctuations affect how much you can buy overseas. Buying imported goods? A weaker dollar makes imports more expensive. Investing globally? Your returns might rise or fall based on exchange rates. Holding foreign currency accounts or crypto? You're exposed to central bank decisions more than you think. Whether you're a student, an investor, or someone saving up for an international trip, the decisions of central banks directly affect your spending power and financial plans. Can you predict central bank moves? Some traders try to game central banks, predicting what they'll do next and making trades accordingly. This strategy is common in Forex trading. But here's the truth. Central banks are like magicians. They often surprise the market on purpose to stay ahead of speculation. That's why Forex trading is super risky, and why only pros with deep research and risk management should try to outsmart central banks. Fun fact, the phrase, "don't fight the Fed," exists for a reason. It's a warning that the Fed's influence is too powerful to ignore in any market strategy. Let's quickly wrap up what we've learned. Central banks are the puppet masters of the Forex market, controlling currency values more than any hedge fund or investor ever could. They influence Forex through interest rates, QE, direct intervention, guidance, and currency pegs. Their actions affect your daily life, even if you're not trading currencies. And while you can't beat them, you can understand them. And that gives you the edge in managing your money smartly. In a world where global currencies are bouncing around like ping pong balls, understanding central banks is like holding the paddle. You might not control the game, but at least you're not getting hit in the face. If you found this helpful, give this video a thumbs up and subscribe to Finance Sensibility for more easy-to-understand financial wisdom. And tell us in the comments below, do you trust central banks? Or do you think they play too many games with our money?